let me start off with this example. I have new traders. I've seen this one very common as a very common factor. You have a stochastic, then you have an RSI, and you have a MACD, which I've plotted all three over here. Then you have some moving averages. Now within all this, your price action is just not clear. You cannot see the price action, and there's a first mistake that a trader does make. Now let's start off with the 3M's. Okay, what my idea of the 3M's are. Now the 3M's are money, mind, and method in that particular order. If I distribute a trade plan, if you can call it a trading procedure, if you can call it, on a scale of 1:10, then money, which is your money management, takes up about 5 parts. Your mind factor, which is your discipline and your patience to follow a trade plan, prepare a trade plan, and follow it rigorously, takes up 3 parts. The method that we are talking about, the techniques, these indicators, the price action, anything for that matter, takes up only 2 parts. So your techniques or your methodology is the least important part of trading. Now, unfortunately and ironically, most of the traders are really not aware of this. Now, even within the method, this is something which I have come across, that price action rules. Indicators are always lagging, and this is the reason why I've put on these charts. Let's have a look at these charts. But most of the indicators are lagging, and you should use indicators in the right perspective. In our previous sessions, we have had a discussion. We had a complete webinar on the best use of indicators, on what indicators should be used in which situation, right? As all indicators are lagging. So you cannot use just all indicators everywhere. Within the 3M's, so let's say what a new trader does is he or she comes across trading and concentrates only on the 2 parts out of 10 of technical analysis. So first of all, you're ignoring the 8 parts. So you put yourself at a disadvantage. Now, even within the 2 parts, even within the method, they are concentrating more on the indicators. So I would say they are concentrating on only 0.5% of the entire trading process. And then is it surprising that most new traders lose money? It's just a procedure, right? So let's take an example of this one. First, let's start off with the least important factor, which is the technical analysis. Now, mind you, I am not putting down technical analysis or saying that it's not important, because what we are doing is we are trading on the charts. And our starting points is technical analysis, obviously. So it does hold a lot of importance, but at the same time, you have to use it in the correct perspective. So with technical analysis, let's use indicators, right? Now, all 3 of the indicators which have been used in the lower windows, the stochastic, the RSI, and the MACD, they are all oscillators. Now, I've gone over this before, that any indicator which is banded between a value of 0 to 100 is known as an oscillator. Now, one thing about oscillators, which again most traders, new traders, or even a lot of experienced traders also are not aware of, is that oscillators do not work in a trend. They work when prices are range bound. And let's take an example of this. Let's just zoom this inside and let's have a look at this downtrend. Right? We are talking about this particular downtrend. Let's trade on the hard right edge of the chart. So let's say you are trading, you are in a downtrend right over here on the hard right edge of the chart, and you keep going down, and your indicator, let's just take the stochastic for the time being. I'm not even looking at the RSI and the MACD. The stochastic goes into the oversold region below 20. Now, the books say, the textbooks or the indicator studies, that they say that if an indicator is oversold, it means that it's ready to change trend. So you expect price to move up. Now let's put this point in perspective again over here, that this particular situation or this characteristic of an oscillator works when price is range bound. When it is in a range and price goes from oversold to overbought levels, it does tend to change trend faster, or better you can call it. But when price is in a trend, and let's see the example over here. Let's take it one step forward, right? What you do have, let's take it a little forward. There you go. Now, this is a classical example. You had a nice up move. Your stochastic has moved from the oversold area of 20, started moving up. It's crossed over. The lines have crossed over. The price has broken a moving average. It has closed about a moving average, and this looks good for a long. Let's go long. Isn't this exactly what the textbooks say? Right? This everybody, every new trader, every even experienced trader would probably look at this and say, okay, this is a good place to go long. And what happens? Boom. You get stopped out, obviously. What happened over here? Price did close above the moving average. Your stochastic did move from the oversold area. Your RSI, you take the 70-30 area, it did bounce from the 30 area. Your MACD was in your oversold area and the signal line started moving up, and yet price went down. What happened? Right? Isn't this exactly what new traders say, that I did everything as per the books, but yet it happened? The markets are against me. I'm very unlucky, and I don't know, I'm doing everything correctly, but it just doesn't work. But what you're doing is you're not using the correct perspective. Right? Let's eliminate the RSI and the MACD for the time being right now. Let's just remove this. Let's just keep the stochastic, because I have a reason for keeping the stochastic. Let's concentrate on, for the time being, on the moving averages. Now, the moving average, I consider the moving average to be one of the most lagging indicators of price. Moving averages can be used accurately. They should be used in perspective, ideally to determine a trend or to look for levels of support resistance, never to enter or exit a trade, believe me. Because if you're going to enter and exit a trade, you are going to get into price when more than half the move is completely over. Let's take this particular example. This was a trade which was taken. That's the reason why I've chosen this. This was a bullish divergence, and I'm just looking at the stochastic for the time being. Let me even remove the MACD. I don't need it. Right? Let's concentrate. This is what we call as a bullish divergence. Now I use the stochastic to determine divergences, because for me the stochastic is the best indicator to determine a divergence. An RSI can also determine or indicate a divergence. Your MACD can also do the same, but the stochastic has certain characteristics which make it much better. And this is a classical, what we call as a class A divergence, where you have price making low, lower lows. You have the stochastic making a low. Your first low was in the oversold area below 20, and when price made a lower low, your stochastic, the second low, did not go below 20. You see, it remained above 20. Now this is the difference between the stochastic and other oscillators. This classifies as a class A divergence, which is one of the best divergence or best indications of the change of trend. So we traded this. Forget about the targets for the time being. Let's just talk about the entry. In this case, we entered somewhere. Let's take a simple support resistance level. Right? If I plot a line somewhere over here, or let me plot a band somewhere over here. Now, the simplest way that one can, of course, I use a lot of Fibonacci's to get into an entry into a trade, but the simplest way one can really look for is if on a break of a very important or a strong zone of support resistance. So we had price finding support over here. As you can see, there was support here, and then on its way up it found resistance. So you would have probably kept your order a little above this. Let's say that we entered when price broke this zone of support resistance. Would have been a good trade. Your expected target was, I use a fibs, so I'll use a fib projection. 127 is the minimum target, so 127. Right? This was your target. Now, if you're using your moving averages, what do the moving averages tell you? Now, I've used a combination of, let's say, whatever, 9 and 50, which is a very common exponential moving average. You would have entered on the crossover of the moving average. You would have entered your trade over here. How much of a move would you have lost? This much of your move. And your exit is pretty close by. Now this makes a difference on your risk to reward ratio. So your moving average is very, very lagging. If you're going to use your moving average to enter a trade or even exit a trade, believe me, you're headed for trouble. Use price action.